Hi, I'm Daniel Brereton, Director of Investor Relations at Equity Multiple. One of the most commonly heard terms in commercial real estate is the capitalization rate, or cap rate. Let's get into what a cap rate is and what it means. Capitalization rate, or cap rate, is a key metric used to analyze potential investments and objectively compare one investment to another. Knowing a property's cap rate helps an investor to assess the risk, as well as the return of a potential investment. As a real estate investor, you will use this metric to both identify a good investment opportunity and determine the property management effectiveness for your existing portfolio. Mathematically speaking, a cap rate is the net operating income, or NOI, divided by the purchase price of the building. It's essentially the income yield of the property. For example, if a landlord earns $1,000 per month after expenses on her duplex, so $12,000 per year, and paid $200,000 for the property, then the cap rate is calculated by dividing $12,000 by $200,000, and that gives you 6%. A property with a lower cap rate means lower risk, while a property with a high cap rate typically comes with higher risk. The higher cap rate typically reflects a less desired location or older building vintage. However, just like a savings account, the rate of return can be so low that there is no profitability or cash flow if a cap rate is too low. Somewhere in between, investors hit that elusive sweet spot. Just enough risk to generate an acceptable reward. Cap rates are also a good tool to compare the pricing of your properties to comparable sales. The highest cap rate doesn't necessarily equate to the highest potential risk-adjusted return. A number of other factors come into play. The trending of cap rates within a given CRE sector or market are key. If you can confidently forecast a property's cap rate, that it will go down over the term of the investment, and that rents of the property stay at least as high, your selling price is therefore higher than your purchase price. In other words, the lower exit cap rate, all else being equal, bodes well for an investor. Going back to our example, if that same duplex had a 6% cap rate, if the landlord can increase rents and earn now $2,000 a month, so $1,000 per month more, that's $24,000 per year. If the cap rate stays steady, the property should now be worth $400,000. On the other hand, cap rates can also potentially go down for a few reasons. This cap rate compression can result from both macroeconomic factors and asset-specific factors. An area becoming less desirable, like when an anchor employer moves, or changes in demand for certain asset types, like when employees no longer are working in the offices, can cause property values to drop and cap rates to rise commensurately. As we've seen, the cap rate is a simple metric that can be used to evaluate real estate opportunities. However, there are several factors that must be considered when comparing cap rates across investments. Location, asset type, and vintage all will play some part in what cap rate is at any given moment. As always, there is no one cap rate that is ideal for each situation. To learn more or to answer any questions, reach out to ir@equitymultiple.com.